Hello and welcome to the class of your ACCA Financial Accounting. In last class, we have studied about the different types of business entities and their different types of capital structure, where we particularly focused on the capital structure for limited liability company, where we have studied the first capital structure is regarding the ordinary equity shares, then preference share, and then the borrowing or loan notes. Then we have studied what is the meaning of each types of financing and their features along with the journal entry and accounting adjustment. So this is what we have studied in the previous class. Now today we need to understand about the two more issue of shares. First one, the issue of ordinary equity shares. Sorry, the first one, the issue of right issue of shares. The issue of right issue of shares, and the second one which we need to study today is the bonus issue of share. So these are the two topics which we need to understand and study in this class. First, start with the topic which is the right issue of share, which is the right issue of, to be specific, ordinary equity shares. Okay, now what is right issue of ordinary equity share? Let's understand. Suppose if there is a company having, if there is a company which is having 1 lakh number of shares, a company having 1 lakh number of shares, and the name of shareholders are, and the name of shareholders are A, B, C and D. So these are the name of shareholder which are having the share in the company, and company is having 1 lakh number of shares which are ordinary equity share. Now suppose A, B and C has following number of equity share. Suppose A has 10,000 equity shares, whereas B have 40,000 equity of shares, C have 30,000 equity shares, and D has 20,000 equity shares. So these are the total of equity share which are occupied or holding by the following number of people A, B, C and D. So if you add this up, 10 plus 40 is 50, 50 plus 30 is 80, 80 plus 20 is 1 lakh. So this accounts to total of 1 lakh number of equity share. That means the entire shareholders of this company are these four people A, B, C and D, which are holding following majority in the shares. Now if you ask me how much percentage does A is holding in the company, then the answer is simple. 10,000 divided by 1 lakh is equals to 10%. And in the similar way, we can have the percentage holding of each shareholder, whereas B is holding the 40%, C is holding the 30% share, and D is holding the 20% share of the company, which is total of 100%. Simple. Now suppose in this example only, the company is planning to issue further number of equity share. The company is planning to issue further number of ordinary shares. The company is planning to issue further number of ordinary shares, which is 50,000 ordinary equity shares, which is 50,000 ordinary equity shares. Now suppose if company issues these shares to public or to other person, then the condition will be that A, B, C, then D and the new person which is E. So what is the shareholding now? Suppose if this is the issue, then A will have its 10,000 share, B will have its 40,000 share, C will have its 30,000 share, D will have its 20,000 of share which was earlier as follows. But the new share which are 50,000 suppose are issued to E, or E subscribed all the share which is 50,000, then the total of shares are 1,50,000, 1 lakh which was earlier issued and 50,000 which was the new issue of share. Now if I ask you what is the holding and in terms of percentage, the formula will be 10,000 divided by 1,50,000. Hence the percentage came to 10,000 divided by 1,50,000. Please use your calculator. The answer will be 6.67%. Then for 40,000 the percentage will be 26.67. For 30,000 the answer will be 20%, and for 20,000 it will be 13.33 percentage, and for D the answer will be 33.33%, which is total of 100%. Now what happened? The A, which was holding earlier 10%, is now reduced to 6.67%. B, which was having 20% shares, are now reduced to 26.67%, and C, which was having 30%, is now reduced to 20%. What this resulted to? This decrease in share in the company resulted in dilution in the share of profit and also in the voting power, or the voting right. Hence there is decrease in the number of shareholding in the company, your voting right also decreases. So this is the disadvantage if you issue new share to new people instead of the people which are already holding your shares. Okay, so to tackle this and to eliminate this condition, a new rule is introduced by the law or the Companies Act in different nation. Okay, so to avoid this, what has been introduced? It has been introduced that the further or the subsequent shares will be first offered to the existing shareholder. The subsequent or further issue of equity share will be offered to the existing equity shareholders in the proportion in which they are originally holding the share. So first the old equity shareholder are asked to get the share in the proportion in which they are originally holding the shares at a price which is lower than the issue price. So if company is planning to further issue 50,000 ordinary share, then company should ask first A, B, C and D to get this share if they want. Otherwise then only this share will be issued to new people. So this is called as right issue. This is known as right issue because old shareholder, the existing shareholder, has the first right to purchase the share. The old shareholder or the existing shareholder has the first right to get the share. Hence this is known as right issue of share. And this is issued at a price which is lower than the issue price. So this has been issued at a price which is lower than the issue price. So suppose if the nominal value is $1 of the share and the issue price is $15, then the right issue price will be lower than the issue price. That means the right issue price will be suppose $13. So this is the price at which share will be first offered to the existing shareholder, which are A, B, C and D, and in the proportion in which they are holding the original shares and in the proportion in which they are holding the original share. So this is the proportion in which they are holding the original share: 10%, 40, 30 and 20%. So suppose if company is planning to issue 50,000 further equity share, then the NT will be as follows: that 50,000 share will first be offered to A, B, C and D. And what they are holding? They are holding 10%, 40% and 30 and 20%. So the 10% of 50,000 will be 5,000 share will be offered to A. Then 20,000 share will be offered to B. Then 15,000 share will be offered to C, and then 10,000 share will be offered to D, which makes the total of 50,000 share, will make the total of 30,000 shares. Okay, so the journal entry for issue of this share. Now we are going to issue the share. Okay, so for accounting, the journal entry will be same as issue of the original equity share, because accounting does not difference between right issue and original issue. Okay, only the law differentiate between right issue and equity issue. So the journal entry will be bank accounts debited, bank accounts debited to ordinary equity share capital. The journal entry will be bank account debit to ordinary equity share capital account, which will be classified as equity or capital in the statement of financial position, will be issued classified as equity or capital in the statement of financial position. Then the amount, which is the difference between the right issue price and the nominal price, is the share premium. So the entry will be to share premium reserve account. The entry will be to share premium reserve account, which will also be classified as equity or the capital in the statement of financial position or in the balance sheet. So suppose if the right issue is of $13, so we will receive $13 in the bank. And what is the nominal amount? The nominal amount is $1. So we will record 1 as the place of share capital, and the difference between issue and nominal will be $12, will be issued as right share premium on the issue. So journal entry will be same. Okay, so this is all regarding the right issue. Now question is that after having the right issue, what is the percentage? Now suppose A, B, C and D are holding share, which was earlier as 10,000, 40,000, 30, 20, 10,000, 40,000, 30 and 20. Okay, so what is their old holding? Their old holding was 1 minute 10, 40, 30, 20. Okay, 10, 40, 30 and 20. This is their old holding. Now after getting the new share, which is this 5,000, 20,000, 15,000 and 10,000, what is their holding? So 5, 20, 15, 10. 5, 20, 15 and 10. This is their new holding. Okay, so total holding which they are having now is 15,000, 60,000, 45,000 and 30,000 of equity share. So this is the amount of share which they are holding. Okay, now if you make the sum of these number of share, the earlier amount was $1 lakh, then $50,000, then the total will be 1,50,000 shares. So these are the number of shares which they are holding now. Okay, now if you make percentage of holding, if you calculate the percentage of holding, the formula will be simple: 15,000 divided by 1,50,000. So the holding is 10%. Then 60,000 divided by 1,50,000, the holding will be 40%. Then 45 divided by 150, the holding will be the 45 divided by 150, the holding will be 30%. Then 30 divided by 150, the holding will be 20%, which is total of 100%, which is total of 100%. So this is the holding. Now this is same as issue of earlier share. So this is same as they are previously holding, which is 10%, 40%, 30% and 20%. So this is the same power which they are holding now. Hence there is no dilution. There is no dilution in the share and also no dilution in the voting right. Okay, so there is no dilution in their share of the company and no dilution in their voting power or voting right. Hence right share is issued first to the existing shareholder so that they can hold their voting right in the company without diluting them. Okay, so this is the concept of right issue of ordinary equity share. This is the concept of right issue of ordinary equity share. Okay, so I hope you are able to get it. Now comes to the notes where we are going to study it from our concept note, which is right issue of ordinary equity share, which is right issue of ordinary equity share is a right issue is the issue of new shares. A right issue is the issue of new share to existing shareholder. A right issue is when a company offers existing shareholder the right to buy new share. So this is the right which company offers to existing shareholder. This is the right which company offers to existing shareholder to right to buy the new share, usually at a price below their current market price. So this is the price at which they offer the share, which is usually below than the current market price. And journal entry will be bank account debit because you're getting the money, to ordinary equity share to share premium account. So the entry is similar when in case of issue of ordinary equity share, whether it is the issue of right issue of share, and narration will be being right share issued to ordinary equity share holders. Okay, so this is the simple concept of right issue of equity share. Now I am giving you 5 minutes or 2-3 minutes to read this, then we will go for the second topic, which is bonus issue of share. Okay, so please read this, then we will go for the bonus issue of shares. Okay, so I hope you are done reading with the concepts. Now we come to our next topic for the day, which is the topic number 2, the bonus issue of shares, which is the bonus issue of ordinary equity shares. So we need to understand what is the bonus issue. Sometimes company gives share or without the consideration to their existing shareholders. What I am saying, sometimes company give shares to their existing shareholder without any consideration, without any exchange of money. This is known as bonus issue. Hence, the bonus issue is the share which existing shareholder will receive at free of cost. Suppose if company is having the profit, if company is having the profit in form of or in the form of reserves. Okay, so company has certain reserves from the profit which they have made in this year or during the previous years. Now company wants to utilize these reserves to issue equity shares, to issue equity shares to their existing shareholder, to their existing shareholder. I am writing SH in the short form for shareholder. Okay, so this issue which company is going to issue to their existing shareholder without any consideration, the issue without any consideration is termed as the bonus issue of ordinary equity share, the bonus issue of ordinary equity shares. Okay, so this is the concept of bonus issue of equity share, where companies utilize their reserves or retained earning or the profit to give shares to their existing shareholder without any exchange of money. Let's understand this with the example. Suppose if there is a company having 1 lakh number of ordinary equity share, this is a company having 1 lakh number of ordinary equity shares, and the company has decided to issue bonus share in the ratio of the company had decided to issue bonus share in the ratio of 3:4, in the ratio of 3:4 to their existing shareholder, to their existing shareholders from, or you can say by utilizing their reserves, by utilizing their reserves. Okay, so this is the example where company is having 1 lakh number of equity share and the company has decided to issue bonus share in the ratio of 3:4 to their existing shareholder by utilizing their reserves. Okay, now what is this ratio? What is this ratio? The ratio of 3:5. So let's understand with the solution, which is a ratio of 3:4. That means company will issue 3 shares. The company will issue 3 shares against the 4 shares. The company will issue 3 shares against the 4 shares. Suppose if the company is having shareholder A, B, C and D, and A, B, C, D are holding shares in the number of 10,000, 40, 30 and 20. 10, 40, 30 and 20. So this is the number at which they are holding the share. 10, 40, 30 and 20. So this is the number at which they are holding the share, and the ratio came out for the bonus issue is 3:4. So they will get 3 ratio for every 4 share. They will get 3 shares for against the share against 4 share. So 3 share will be issued for 4 shares. So for A, who is having 10,000 share, will get 3 divided by 4, multiplied by 3 divided by 4. For every 4 share he will get 3 share. So the number of share that A will have is 10,000 divided by 4 multiplied by 3, that is 7,500 shares. Then in the same case, B will get 3 shares for every 4 share. So he will get 30,000 shares. Then C will have 3 divided by 4, which is 30,000 divided by 4 multiplied by 3. So C will have 22,500 number of share, and then D will have the same proportion of number of share, which is 20,000 divided by 4 multiplied by 3. So D will have 15,000 number of share, which is total of 75,000 shares, which is total of 75,000 of share, which is came as 1 lakh was the original number of share multiplied by 3 divided by 4 is equals to 75,000 of shares. So 75,000 of shares will be issued as free to their existing shareholder. Will be issued for free to their existing shareholder without charging any money in the form of consideration, and this issue will be given by the use of reserves or retained earning, which is the profit of the company which they are having from the past year or the current year. So this is the concept of bonus equity share. Now, as the share has been issued, the general entity will be, first to issue the share. So we will have two ordinary equity shares. We will write two ordinary equity shares account or share capital account, okay, which will be classified under equity or capital. It will be classified under equity or capital. Now, for share premium, the entity will be same, to share premium reserve account, to share premium reserve account, and entity will be same, will be classified under equity and capital. Now, what will be going to be debited? Because you are not getting any money. You are getting any money? No, you are not getting money, because bonus share are issued without any consideration. This is for free, and these share are issued by utilizing the reserves of retained earning. So reserves and retained earning generally have the credit balance. Reserves and retained earning generally have the credit balance, and when you are going to use it, what you need to do? You need to debit them, because they have the credit balance, and when you are utilizing them, you need to debit them. So we will debit the retained earning, the retained earning or the security or share premium reserve. We will debit security or share premium account debit in exchange of issue of share in the bonus issue. So this is how journal entry is going to be done, okay. So this is the concept of bonus issue of share, where share are issued at free of cost to their existing shareholder in the ratio given by the company, okay. So this is the example for bonus equity share. Now comes to the concept bonus issue of ordinary equity share. A bonus issue is the issue of new share by the company. So it is the issue of new share by the company to existing shareholder in proportion to their existing shareholder for no consideration, or cash. So you are not getting anything against the issue. Now, what is the journal entry for the bonus issue? The journal entry is share premium account debited or retained earning account debited, because these are having the credit balance and now you are utilizing them to issue the share. So share premium or retained earning account debited to ordinary equity share capital, as new share has been issued by utilizing the equity retained earning or the security premium reserve or share premium reserves, okay. So this is the journal entry for bonus equity share. So till now we have studied right issue of share and bonus issue of share. Right issue of share is also to the existing shareholder, but at a price lower than the issue price. But bonus issue are the issue to the original existing shareholder, but at free of cost, okay. So you are not getting anything in the return, hence they are termed as bonus, and they are termed as right issue because existing shareholder has the right to get the share first. So they are named as right issue of shares, okay. Then the next topic for today is the cost of capital. The next topic which is for today is the cost of capital for business. So For ordinary equity shares and for preference share, what are the finance? The ordinary equity share and for preference share, the cost of capital is dividend. So we need to understand what is the cost to get the capital from equity share or from the preference share. So if you have taken the capital from the equity share or from preference share, so what is the cost which you need to incur against this capital is the dividend, because you need to pay them back in the form of dividend. So dividend becomes the cost of these types of financial structuring. Then comes borrowing or loan notes. So for borrowing and loan notes, the cost of capital is the interest cost, which is also known as finance cost. So suppose if you have taken the capital from equity share or from preference share, then the dividend is the cost. But if you have taken the borrowing or loan notes, then the cost of capital is the interest which you are going to pay for the loan. Simple. Now we need to understand each cost in detail. First of all, start with the dividend on ordinary equity share. First start with the dividend on ordinary equity shares. Okay, so the dividend payment to ordinary equity share can be calculated using various methods. So the dividend which you are going to pay to the ordinary equity shareholder can be calculated by using the different methods, which is first the percentage of profit for the year, which is the percentage for the profit of year. Suppose if the company has earned a profit of 10 lakhs dollars. Okay, and now company has decided to pay dividend at a rate of 2% on profit. So the 2% of 10 lakh will be calculated as the dividend. So 10 lakhs multiplied by 2% comes to the total value of $20,000. So $20,000 is the dividend which is issued to the shareholder. So this is the first method from which you can calculate the dividend payment, that is percentage of the profit for the year. Clear? Then we have second method, which is percentage of par value of the issued share. Percentage of the par value. When it comes to par value, it is the nominal value. It is also known as the nominal value, which we have studied earlier, or also known as the face value. Okay, so if company is having the share at the rate of $10 face value, if company is having the share at the rate of $10 face value, and company had decided to distribute dividend at the rate of 10% on face value, then the dividend amount will be $10 multiplied by 10%, which comes to $1, Okay, so this is the second method of calculating dividend, which is percentage of par value of issued share, where the face value is the main base against which the percentage is calculated. Suppose if the share is having the face value of $10 and company had decided to issue dividend at the rate of 10% on the face value, then the amount of dividend will be $1 per share. Clear? Then the third, the last but not the least, is the dividend per share, which is very simple. Suppose if the company had decided to pay $1 as dividend per share. So whatever the number of shares will be there, all will get $1 as the dividend. So this is the types of method at which dividend can be calculated. First is the percentage of the profit for the year, then percentage of par value of the issued share, and third is the dividend per share. So these are the three methods at which dividend can be paid. Now comes to the journal entry, which is the accounting treatment, comes to the journal entry for dividend of ordinary equity share. So as you are paying the dividend, so you are getting the money out from your entity, so to bank account, because your asset has been decreasing, so to bank account, which is the asset, and against whom you are giving this money, against the reserve, which is the profit which you have earned, because you are distributing the profit, so you need to utilize that profit to give the dividend. So journal entry will be retained earning account debit to cash and bank. retained earning, which is the equity and capital, to cash and bank. So you are giving the dividend against a profit which you have made. So you are sharing profit to your shareholder in the form of dividend. So your profit will be reduced. So whatever the profit which you have as the credit balance will get utilized. So you debit the retained earning and credit the amount which you have paid through bank. Okay, and narration will be being dividend issued. Narration will be being dividend issued. Simple. Now comes to the next cost, which is dividend on irredeemable preference share, which is dividend on irredeemable preference share. First we have studied dividend on ordinary equity share. Now we are studying dividend on irredeemable preference share, which is irredeemable preference share do not require the investment to be repaid, as they are irredeemable, so they are not supposed to be redeemed back or repurchased back. Hence they do not require the investment to be repaid and are classed as part of equity. And they are classed as part of equity. They are not considered as liability. They are considered as part of equity. The dividend payable is treated as an appropriation of profit. The payment of dividend which is going to be paid to irredeemable preference shareholder are treated as the appropriation of profit. What is appropriation? The distribution of profit will be treated as the distribution of profit, because you are giving your profit to the preference shareholder which are irredeemable. Now, in the same way as dividend on ordinary equity shares, so you are the dividend, what is the dividend you are paying to irredeemable preference shareholder is the same which you pay to the ordinary equity shareholder, in the meaning that is the same for accounting. Now, the journal entry for dividend on irredeemable preference shareholder is same which is done in the course of ordinary equity share, which is retained earning account debited to bank, which is retained earning account debited to bank, and narration being dividend paid or issued, being dividend paid or issued. So journal entry in both the cases are same. This journal entry here is same as journal entry here, because for ordinary equity shareholder they are also classified as equity, and irredeemable preference shareholder are also classified as equity. So both the entry will be same for their dividend payout. Clear? So we have studied dividend on ordinary equity share and dividend on irredeemable preference share. Now we need to study the dividend on redeemable preference share. We need to study the dividend on redeemable preference share. So what are redeemable preference share? Redeemable preference share carry an obligation to repay. They carry the obligation to repay, because you are going to repay the amount to redeemable preference shareholders, and the investment are classified as liabilities. The investment on redeemable preference share are classified as liability, because you have the obligation to pay them back. You have the obligation to pay them back. Hence, dividend payment for redeemable preference share, hence dividend payment for redeemable preference share are treated as interest expense. Hence, the dividend payment which you are going to make for redeemable preference share are treated as interest expense, are treated as interest expense. Okay. Now, the journal entry for dividend or redeemable preference share are as follows. The journal entry will be as follows. That is, you are going to pay the amount from your bank, so to bank, because bank is decreasing, and you will record it as the expense. You are going to record it as expense, because you are going to treat this dividend as the interest expense, because this is your liability. So entry will be interest expense account debited, interest expense account debited to bank. Okay, so this is not the dividend as it was there in the case of ordinary equity share and irredeemable preference share. This is the case of interest cost, where you are going to give dividend to redeemable preference shares. Okay, so entry is interest account debit to bank. Clear? Now comes to the last cost, which is interest cost on borrowing, which is interest cost on borrowing. So borrowing gives the holder, the lender, the right to receive the fixed return interest, as we have studied in the first class that borrowing has the fixed charge as the interest, and they will be repaid at some point in the future. So they will get interest each year, and at the end of the term of the loan they will get their money back. The interest is the cost of borrowing capital and is treated as interest expense. So whatever the amount you pay as the interest on the loan or on the loan or on the borrowing will be treated as interest expense, will be treated as interest expense, and the journal entry will be interest expense account debit to bank. Journal entry will be interest expense account debit to bank. Okay, so this is the cost of capital for borrowing or loan notes. Okay, so if we make the summary, of the cost of capital, if we make the summary for the cost of capital, so we can identify that ordinary equity shares and irredeemable preference shares are treated as similar. They are having the similar treatment. Okay, they are having the similar treatment where the payment which they made is considered as dividend. The payment or the cost they incur for this capital is considered as dividend. Whereas in the case of redeemable, preference share, and in the case of borrowing or the loan note, the payment for capital is considered as interest expense or the finance cost is considered as the interest expense or the finance cost. So this is cost of capital for different types of capital structuring. For ordinary equity shares and for irredeemable preference share, it is treated as dividend, and for irredeemable preference share and for borrowing or loan note, it is treated as interest expense. Clear? So this is the cost of capital for different types of capital structuring. Okay, I am giving you 5 minutes to read this, then we will go for the next concept. Okay. Okay, so I hope you are done reading with the content. Now comes to the next topic for the day, which is equity component in the statement of financial position. So whenever the term financial position comes, we need to identify this is the short form of it, statement of financial position, SOFP, which is also known as the balance sheet, Okay, so a company's total capital and reserves are the difference between total asset and the total liabilities in the statement of financial position. So what is total capital and reserve? The total capital and reserves is the difference between the assets minus liability. The difference is the total capital and reserves of the company. Okay. The reserves are the fund that may be used for a specific purpose. So what is the reserve? The reserves are the fund that may be used for the specific purposes. Reserves do not represent cash. The main thing is that reserves do not represent cash. So suppose if you are having $1 crore of reserve, that does not mean that you also have $1 crore of cash. So reserve does not represent cash. Okay, so don't get it confused with the reserves of economics. In economics, reserves are considered as cash, but for accounting, reserves are not representing the cash, whereas reserves are not the provision. Even though it is having the credit balance, reserves are not provision, because provisions are what? Provisions are the liabilities of un, un the provisions are the liabilities of amount which is uncertain and uncertain timing. Liability provisions are the liabilities of uncertain amount and uncertain timing. So reserves are not the provision. Reserves are the funds that may be used for a specific purpose, and reserves do not represent cash. Okay. Now comes to the topic which is regarding the reserves only. The reserves are divided into two categories. First one is distributable reserves, and the second one is non-distributable reserves. So reserves are categorized into two categories: distributable and non-distributable. The distributable reserves has no restriction. The distributable reserves have no restriction. That means they can be used for any purpose. So whatever the amount which you are having in the distributable reserves are used for any purpose, which is example retained earning. So retained earning is the example of distributable reserves. On the other hand, a non-distributable reserve, is one for which there is a specific use. So if you are having any specific use, then only you can use the non-distributable reserve. Otherwise it is not for distributing for every other things. The example for which is share premium account. So share premium account, or the money which you are having in the share premium account, is not going to be used for any general purpose, because it is the example of non-distributable reserves. Now first come to the share premium. So what is share premium? Share premium is the difference between the amount of issue price minus the face value or the nominal value. Okay, so what is share premium? Share premium is the premium which you have received as the difference between the issue price and the face value of the share. It is not available for distribution, as it is considered as non-distributable. It is not available for distribution because it is the capital and not the profit. Because this is the capital, suppose the share which is having the $1 of nominal value has been issued for $15 of issue price. So the difference between both 15 and 1 is $14, which is the share premium. So this is the capital. And not the profit. So this is not the profit. This is capital, because you are not earned it from your trading activities. You have got it by issuing the capital. Hence its limited uses are: first, issue of fully paid bonus share. So what you can do with the share premium? You can issue fully paid bonus share. Second, that is to be used for settling preliminary expenses on company's formation. So whatever the expense which you have done before forming the companies are known as preliminary expenses. So you can use this to set off or pay back these expenses. Then third is paying a premium to redeem share or borrowing. So if you are going to redeem your share or borrowing on premium, then also it can be used, because this is the non-distributable form of reserve. So share premium is non-distributed form of reserve, hence it has only limited uses, which is first, issue of fully paid bonus share, second, settling preliminary expenses, and third, paying a premium on redemption of shares or borrowing. So this is regarding the share premium, which is the capital and not the profit, because this is the capital which you have gained on issue of share at a price higher than the nominal price. So this is capital and not the profit, because you have not earned it by using your trading activities. Okay, so this is about share premium. Then we have revaluation surplus. Sir, where we have studied revaluation surplus earlier? In the chapter number 9, which is IAS 16, which is deals with PPE, plant property and equipment. So we have studied about revaluation surplus in chapter number 9. So what is it? It is the cumulative unrealized gain. It is the cumulative unrealized gain. Why it is unrealized? Because only your value increased based on market price. Your value of PP has been increased based on market price. You have not get that money yet because you have not sold the asset. So this is unrealized gain on revaluation of non-current asset, typically land and building. So whatever the increase is there in the non-current asset is the unrealized gain, known as revaluation surplus. It cannot be used for dividend payment. So this amount cannot be used for payment of dividend. Hence, this is the non-distributable reserve. Until the actual surplus is realized from the sale of the asset. Now, what does this mean? Suppose if you are having the revaluation surplus. Okay. Suppose the carrying amount of non-current asset is $80,000. The carrying amount of non-current asset is $80,000. Then you have the fair value based on market. The fair value of non-current asset as $1 lakh. Okay, so you have the carrying amount $80,000 and you have the fair value. Now the difference between both, that is $20,000, is the revaluation surplus. Because it is increased in the fair value, which is considered as unrealized gain. Because this is not which you have realized. Even though the value has been increased based on the fair value on the market, this is amount which you have not get because you have not sold the asset. So this is termed as unrealized gain. But suppose if you sell this non-current asset, for $1 lakh. So what will be the entry? The entry will be bank account debited by $1 lakh to non-current asset by carrying amount 80,000 to gain on sale or disposal of non-current asset, which is $20,000. So now this 20,000 which was earlier classified as unrealized gain in the revaluation surplus has been realized. Okay, so this is about the revaluation surplus. Until you sell off the non-current asset, this will be classified as unrealized gain, and after selling it will be classified as realized. So you cannot use the revaluation surplus for dividend payment, as it is non-distributable until and until means after this only you can use this, that is until the actual surplus is realized from the sale of the asset. So if you have sold off the asset, then you have realized the surplus, then only you can use it as the amount. So what is the summary of this? That realization surplus is non-distributable. Okay, unrealized service revaluation surplus is non-distributable, but if realized. If realized, then it becomes distributable. If realized, then it becomes distributable. Okay. Then it can be used to issue bonus shares that are deemed to be paid in full. So you cannot use it for the dividend until it is realized, and after realizing you can use for the anything. But it can also be used for issue of bonus share which are deemed to be paid in full. So what we have studied now, we have studied about the equity component in the statement of financial position, where we have discussed reserves and capital and the types of reserve, distributable and non-distributable, under which we have studied share premium and revaluation surplus. So share premium is non-distributable and revaluation surplus is non-distributable until it is realized. After realizing it, you can treat it as distributable. Okay. Then comes our last topic, which is retained earning. Now what is retained earning? Retained earning is the amount which you kept after paying all the obligation. Suppose company has made the sale of $1 lakh, okay, and had incurred cost of $80,000. So they are left with the profit of $20,000, at which they have paid interest of $5,000, and then they have paid tax for $3,000. So they are left with 12,000 of the dollar of profit after interest and tax. So this is the profit after interest and tax. Now based on this profit which is left after all this thing is 12,000, they have paid dividend of $7,000. Okay, they have paid dividend of $7,000. So the remaining amount, which is the balancing figure, which is 5,000, how it came? $12,000 minus 7,000 paid as dividend is $5,000, is the retained earning. Retained earning means the earning which has been reinvested in the business. What is retained earning? Which is the amount which is reinvested in the company, is known as retained earning. So the earning which you have retained in your company, in your business, is known as retained earning. Okay, so we need to understand what is retained earning. So retained earning are accumulated profit. What is means accumulated? That means whatever happened in the past year, that means accumulated. You have accumulated this in the retained earning. So retained earning are the accumulated profit and an essential component of shareholders equity, this is reinvested in the operation of the business. So this is the reinvestment in the operation of the business. The portion of retained earning may also be transferred to other named reserve to be held for a specific purpose. So you can transfer the amount of money from retained earning to any other reserve, such as the reserves for any other purpose, such means for buyback, for redemption of preference share, or for redemption of borrowing. So you can transfer the amount from any other named reserves. Now this point is just for good understanding, which is a revalued asset is sold when a revalued asset is sold, which we have just discussed in the case of revaluation surplus. The profit or loss on disposal reported in the sale proceed is the difference between sale proceed and the asset carrying amount. Full stop. Which is same as we have stated that the profit on disposal is the difference between the amount which you have received and the carrying amount. Okay, that means $1 lakh and 80,000 in the previous case, that is $20,000 is the profit on disposal of asset. Then the revaluation surplus is then realized. Okay, so once you have sold off the non-current asset, you have realized the revaluation surplus. This realization is not reported in the statement of comprehensive income. So whatever the realization which you made is not going to be recognized in the statement of comprehensive income. Instead, the revaluation surplus on the asset is transferred to the retained earning. So after selling the asset, whatever the revaluation surplus which you have will transfer to retained earning. So the entry will be revaluation surplus accounts debited to retained earning, that is $20,000 based on the previous example, which is this. Okay, which is this. So whatever the amount which you realized and after selling the non-current asset is not going to be reported in the statement of comprehensive income. Instead, the revaluation surplus on the asset is transferred to the retained earnings. So this revaluation surplus has been debited, means done nil, zero, and transferred to retained earning. In the statement of changes in equity, when a revalued asset is sold, retained earning will effectively include the same profit on disposal as if asset has not been revalued. So this means that there is no such change in the retained earning because the revaluation surplus just transferred from equity to equity. That means it was earlier in the equity section, which is in revaluation surplus, which has gone to the equity section only in the head retained earning. So there is no such change. So this is about the revaluation surplus, and this is only for the good knowledge of the concept based on chapter number 9 IAS 16 PPE. Okay, so this is about retained earning. So what we have studied in this class till now: equity component in the statement of financial position or balance sheet, then about the distributable reserves and non-distributable reserve, then the share premium, then the revaluation surplus, and then about the retained earning. Okay, so this is all the simple concept which we have studied in detail. Okay, and I hope you are able to understand all these things. Then the last topic for the day and for this chapter. So only one topic is left for this chapter, which is statement of changes in equity, which is termed as SOKI. So we call it SOKI, statement of change in equity, SOKI. Now what is this? So it is its purpose is to state the changes in equity. So its main objective is to state the changes in the equity that have occurred in the financial year. So it will tell you what is the change in the statement of equity in the financial year. So it will have the opening, you will have the closing, and then you will have the changes during the year. It is the reconciliation between balances at the start and balances at the end of the year for all equity component. So it is the reconciliation. So this is the reconciliation of balance at the beginning of the year and at the end of the year by how it has been changed. The equity section of the statement of financial position. That means the balance sheet includes the following: share capital, share premium, revaluation surplus, and retained earnings. So it will contain these types of name, which is share capital, share premium, revaluation surplus, and retained earning. It will be consisted by the statement of changes in equity. Each of these elements will have its column in the statement of changes in equity. So they will have the separate column. So you will have the separate column for share capital, you will have separate column for share premium, and for share revaluation for surplus, and for the retained earning. So statement of changes in equity is the reconciliation of the amount at the start of the year, at the end of the year, for share capital, for retained earning, for share premium, and for revaluation surplus. Now, this is the format for statement of change in equity. So your statement of change in equity will look somewhat like this. First, you will have particular, where you will have balances at the start of the year. Suppose for share capital, you will have this balance. So this is the opening for share capital balance at the start of the year. Then share premium, then revaluation surplus, then retained earning, then the total of it. So total of all this will be shown here. Okay. So this is the reconciliation. So you will have total of all this, which is equals to this, which is at the start of the year. Then you will have balance at the end of the year. So for share capital, for share premium, for revaluation surplus, for retained earning, and total of all will be shown here in the head of total equity. Okay. Then the second heading is the changes in equity during the year. So what is going to be changed? Suppose if you have made issue of share capital, so it will be shown under the head of share capital, that this is the amount for which you have issued the share. And if you have issued the share, that means you have issued it on the premium. So premium will also have the share of amount which you have received against the share premium. Okay. So whatever change you do during the year will be recorded in their respective column. Suppose if you have paid the dividend, so it will be reduced from the retained earning. Because you have paid the dividend from the profit or accumulated profit, that means the retained earning. So your retained earning will be reduced. Then you have profit or loss. So whatever the profit which you make during the year, the profit made during the financial year will get included in the retained earning. So you will have this in the retained earning. Similarly, whatever the other comprehensive income you made. So other comprehensive income means PPE revaluation. Suppose if you have example PPE revaluation, your non-current asset has been increased. So it will be shown under the heading of revaluation surplus. It will be shown under the heading of revaluation surplus. Okay, so this is the one column. Then total comprehensive income. So after having all this, you will have total of all the comprehensive income. So this means this total, then this total, then this, and then this total. So you will have total comprehensive income, and hence after adding this on the opening, you will have the closing figure as the retained earning. Okay, so this is the statement of changes in equity, where is the reconciliation of all the items from the beginning of the year and to the end of the year. Okay, so this is what we are going to study for SOKI, that is statement of changes in equity. So we have discussed profit, we have discussed statement of financial position and SPL in the chapter number 15, and then SOKI here, then cash flow statement in the respective IAS 7, and all such thing in the respective chapter, which are the financial statement. Okay, so I am giving you again 5 minutes to read all this, then we will go for the end of this class and we'll start solving question in the next class. Okay, so you have 5 minutes to read all this, then we'll go for the next class. Okay, so I hope you're done reading with this, and with this last topic we have completed our chapter number 13, which is the capital structure and finance cost. Okay, so this is all for this class, and for this chapter we are going to solve question in the next class. If you have any doubt regarding the concept, you can always DM me, or you can always DM in the message or in the group, so that we can have the solving of such doubts. Okay, so we'll see you in the next class. Till then, thank you.